Hello, and welcome back to another webinar or podcast, depending on where this recording is going to end up. My name is Tiana Thompson, and I am the CEO of Leapers Connect Consultancy. A little bit about me. I am a business consultant and business and real estate tax strategist. I've been in business for just under a decade. My business has been around for just under a decade. I've been offering consulting services for just over a decade. I'm an enrolled agent and tax strategist. I'm authorized by the IRS to represent my clients in any of the 50 states, and my services for my company includes tax planning, tax preparation, IRS representation, and of course, we also offer bookkeeping services. All right, so let's just jump right into today's session. So we're going to be speaking about 1031 exchange or like-kind exchange. I get so many questions about the 1031 exchange, how it works. Can I do this? Can I do that? And I think what's really important is that my clients and potential clients have this information available to them. So that way they don't have to worry about, having to deal with the IRS because a 1031 exchange is disallowed. And we'll go over how that would apply. Okay. So we're going to go over what is a 1031 exchange? How does it defer your taxes? So it doesn't cancel out your taxes. It's not that you don't ever pay taxes, although there are options or ways that you can structure things so you don't pay the taxes ever for yourself. But it defers the taxes. So instead of selling the property and paying the capital gains right away, you defer those taxes, right? So we're going to go over what is a 1031 exchange, how it defers taxes, what properties qualify, how you can do a 1031 exchange, in what instance would the IRS or instances would the IRS disallow a 1031 exchange, and how to avoid an audit with the IRS, right? So let's get started. A 1031 exchange, also known as a like-kind exchange, is essentially a deferral exchange where it allows you, a real estate investor, to not have to pay capital gains on the sale of an investment property by using the proceeds from that sale and putting it into the purchase of a similar or like-kind property. And I'll go over what like-kind means, right? It's governed by Section 1031 of the Internal Revenue Code, and that's where the name comes from. All right, so 1031 exchange, it just means that the property must be held for business or investment purposes. So you can do a 1031 exchange on a residential rental property. You can sell that and then use the proceeds from that to purchase a commercial office building. So it doesn't mean that you have to swap a residential rental property for another residential property. It just means that it has to be a business use property. That's what you're holding it for another business use property, right? All right, so now that we've gone over that, we're going to talk about the process. So generally speaking, it's a three-step process, generally speaking. um, the day you sell the property, and we're referring to the most common type of 1031 exchange. There's more than one, and I'll go over those. But generally speaking, with a 1031 exchange, let me make sure my audio is on. Yeah. Generally speaking, with a 1031 exchange, it's a three-step process. The day you sell the property, the investment property, is day one, right? And from that day one, you have 180 days to complete everything, right? So it's a 180-day step process. So the day you sell the property or relinquish that property is day one. And then from day one, you have 45 days to identify 3 replacement properties, right? Or to identify the replacement properties. So the properties that you see that you would like to possibly get. Okay, so let's say you're eyeballing 3 properties to replace it with. Those have to be identified within 45 days. So day one is the day of the sale. Within 45 days, you're going to identify 3 replacement properties. And within 180 days of day one, so all of them, it's all within 180 days. So it's not day one, 45 days, then an additional 180. Everything is within the 180 days. All right, and then within 180 days, you must exchange or close on the replacement property, and that completes the 1031 exchange, right? And so who can do a 1031 exchange? A real estate investor, of course. And with the IRS, it's all about intent. So if you're in the business of flipping houses, you can't just buy a property and then uh, fix it up, and then instead of flipping it within 6 months of getting it or 3 months of getting it, you decide you're going to do a 1031 exchange. The property must be held for investment use, so like you're renting it out, and you've had it for a fair enough amount of time where you can say, okay, the intent is investment, and then I'm going to sell it. But if you're in the business of flipping, generally speaking, if you buy a property, you fix it up and you're getting ready to flip it, you can't flip it within like the 3 months and you decide you're going to do a 1031 exchange within like a 6 month period. Generally speaking, that disallows it. It's all about intent with the 1031 exchange. So if you're in the business of flipping, typically a 1031 exchange would not apply to a property that you intend to flip. All right. So we just went over what is a 1031 exchange, who does a 1031 who's qualified to do a 1031 exchange, what was a like-kind property, and the timeline. So now we're just going to do a quick overview of the different types of 1031 exchanges. The delayed exchange is the most common exchange. That's the one we refer to. You buy the property, you have 180 days to close on your replacement property. That's the most common. This is the one right here. And then let's just go back. And then so we spoke about the delayed exchange. Another type of 1031 exchange is a simultaneous exchange, not very common. It's where you complete the sale and the purchase immediately, right? Simultaneously. So let's say I have a residential property and I see an office building that I want to purchase. I'm selling that residential property and closing on the office building simultaneously. That's not very common for more reasons than one, right? And then, of course, we already know the delayed exchange that we just spoke about, 180 days to, so the first day, the day you sell it, is the day one. You have 45 days from day one to identify your replacement properties, and then you have 180 days altogether to close on the property that you are swapping it out for. And another one that is not very common is the reverse exchange. This is where you buy the replacement property first, and then you have 180 days to sell. Now, the reverse exchange is definitely not common, just like the simultaneous exchange. One, because funding is an issue. Getting funding is going to be difficult. Trying to sell a property in 180 days is difficult, and then that's why they're not very common. So that's why I'm referring primarily in this recording of the delayed exchange. All right. All right, so let's talk about the tax benefits. So the tax benefits is a deferral of taxes. So you're deferring having to pay taxes now, so you can not have to worry about paying a chunk of taxes to the IRS. You can defer that and use that to influence the other benefit, which is building wealth. So you can invest those gains into bigger and better opportunities, real estate opportunities. So you can close on another property with that. And then the third benefit is diversification. A lot of persons who would have residential properties, what they would do is they're like, okay, I need to diversify my portfolio. So they may decide, okay, I'm going to purchase this office, this commercial property right here. And, that allows for diversification. So they have different types of streams of income that can offset, like, maybe the economy not being as great as it is, or just to offset things like maybe in the residential real estate, if all the properties are in a specific area, or, for various reasons. So I can go on and on about that, but having a diversified portfolio is good for many in many ways, right? And then let's talk about things to consider. So, remember I spoke about the 1031 exchange, that timeline. Day one is the day you sell it for the delayed exchange. You have 45 days to close on a replacement property and 180 days altogether to close on the replacement property. So 45 days to identify and then 180 days altogether to close after you've sold that property. So an issue with that is it's easy to say, okay, you're going to find three properties in 45 days, but just in this economy alone, in this real estate market is what I meant to say. That's easier said than done. Closing on a property is not an easy feat, and 45 days is really not enough time in every instance when you think about the gravity of what it is that you're doing. So, oftentimes, the 1031 exchange strategy is important. That's where my firm comes in. We assist with, the qualified intermediary, finding a qualified intermediary. We assist with making sure or being able to communicate with you if it's a completely tax-free exchange, a complete tax deferral exchange. Let me say that. So, if it's a case where, you're getting cash, like you're getting cash back out of the transaction where, transactions close and you have cash at the end, that's considered boot, and that's considered a taxable instance. And then another thing to consider is like the qualified intermediary. We have to make sure that you get someone that's absolutely qualified. Oftentimes, a 1031 exchange gets to sell out because the qualified intermediary did not follow the guidelines, right? They didn't follow the guidelines to the T. So let's say it's 180 days that you have to close and it closed 190 days. So you need someone who has, like my firm, who has actual knowledge of the tax law, because it's all good to do the exchange and be done with it, but you got to make sure you understand what it is that you're dealing with. And at all times, you have to keep track of your basis, right? So we can determine any gains that are coming from the gains that are deferred that are coming from the 1031 exchange. And if you do more than one 1031 exchange, keeping track of that so that when you finally sell a property that's under a 1031 exchange, you are disclosing the information correctly, right? So, I know I said a lot there, so I just wanted to just give you some things to think about. All right. With all that being said, you do not want to attempt a 1031 exchange on your own. For a 1031 exchange, a qualified intermediary is required, right? You don't want to sell the property, have the funds in your bank account, and then use that, have access to the funds. Oftentimes that disallows the 1031 exchange. So a qualified intermediary is responsible for making sure like they keep the funds from the sale. And then they provide the funds to purchase the replacement property, right? And they keep track of several things so that you can provide those records from a intermediary that's separate from yourself, so the IRS can take a look at that, right? And you do not want to have access to cash from the sale, as I said before, because it disallows it. So you don't want to have the funds in your bank account. You don't want to be the one taking care of everything. um, you know like I can show you cases where it's disallowed for that. And then a timeline must be followed to the T. Can't be 185 days, can't be 240 days. It has to be all done within 180 days, right? And the property must be for business use. You can't do a 1031 exchange on your personal property, generally speaking. Generally speaking, you can't do a 1031 exchange on your personal property. And as it relates to the tax reporting, which is where my firm comes in, that has to be done accurately. You don't want to make any mistakes on that. We want to be able to determine our realized gain, recognized gain, taxable boot where applicable, right? And with the IRS, one thing I will say, the focus is always on intent. So intentionality is very important. There's a lot of info on the internet, a lot of noise. You have to make sure that you consult and work with someone who's qualified to make sure that 2 years down the line, you're not getting a letter from the IRS that's way more expensive than it needs to be. Right. And then a notable mention here is you want a property of equal or greater value um, for a 1031 exchange. Generally speaking, everybody's needs are a little bit different. You do not generally want any cash or boot from the transaction if your aim is to completely defer taxes. And a 1031 exchange starts and ends in the United States. If you buy a property, if you have a property that you sold in the US, you can't replace it for a property in Mexico, right? And then typically with a 1031 exchange, you can't do a 1031 exchange and immediately cash out on a property, like immediately pull equity from it, because that oftentimes disqualifies it, or the money that you immediately pull out may be deemed as part of the 1031 exchange, and then it becomes taxable, right? And then another thing is you want to hold the property, for business use before you sell it, because the whole purpose of it is to defer the taxes, and then eventually you if you sell, that's when you pay taxes on it. So you don't want to do that immediately. The intent with 1031 exchange is that you're going to hold that property for a little bit, right? All right. And I know I said a lot, so what I'm going to do is I'm going to backtrack and give you a summary, and then I'll go over why it is beneficial to work with my firm and how I can help, okay? All right, so just to go over what we spoke about today, a 1031 exchange or like-kind exchange is the process of, and we're going to speak primarily about the deferred, the delayed exchange, which is the most common, where you defer having to pay capital gains on a business use or investment property, and you do that by selling it and replacing it, selling it and replacing it with a like-kind property, right? And we spoke about the like-kind property being a property of similar use. So it has to be a business use property. It doesn't mean that you have to exchange a residential residential rental space for another residential rental space. You can do commercial, residential, whichever you like. And then we spoke about the timeline. We spoke about the timeline, which essentially it's 180 days. You have a 45-day window within that 180 days from day one to find your replacement properties, and then 180 days altogether to find to close on that replacement property, right? And then we also spoke about the IRS disallow the 1031 exchange if, one example is if your intent is if you're a flipper, typically, you don't typically hold properties for that, and your intent was not to hold a property, and you decide you're going to flip a property within 90 days. You decide, okay, I'm not going to flip it. I'm going to do a 1031 exchange. That's generally grounds for disallowance, and not following the timeline is grounds for disallowance. And how you win or avoid an IRS audit is by staying compliant. All right. So let's talk a little bit about my firm. All right, so here's why you should work with my firm. So offer bookkeeping services. I always lead with that because oftentimes I'll get clients that come in and I'll say to them, okay, they decide they want to do a 1031 exchange or they want to look at strategies, other strategies to lower their taxes, right? And oftentimes, what I will need is a clear view of where their business is at or their investment portfolio, like where they're at financially. And let's say 6 out of 10 times, there's no clear record. I can't pull up a financial statement. I can't pull up a cash flow statement. Um, so in that regard, we do offer bookkeeping to provide that firm foundation so that we can look at tax planning, so that we can look at, strategies, understanding where you're at, how much you've put into a property. So if you do a 1031 exchange, we can determine how much gain you're deferring, right? So bookkeeping is something that we offer for our real estate clients and our business clients. Tax strategy and planning is our specialty for real estate investors, whether it be a 1031 exchange, whether it be real estate professional status, cost seg implementation, or just general overview of looking at your returns to make sure that, your returns look good. Oftentimes I'll see persons who have a lot of things left off where they could have a lot of savings on their taxes. Or let's say, for example, I look at a return and I'll see that land has been depreciated. So the entire cost of the property is depreciated. That's typically something that I'll see 30% of the time with clients. You don't depreciate land, right? So you have to separate the cost of the property out from the land, and then the property is what we focus on when it comes to like depreciation strategies, right? And of course, we offer IRS monitoring, IRS representation, and then real estate and business tax preparation. And you can check us out. We have a website dedicated to our real estate investors, and it's My Real Estate Tax Strategist, no S at the end.com. All right. So once you go on the site, there is an option for you to book a discovery call with me. I typically speak with potential clients directly just to make sure we're a good fit. And we take it from there and we'll take care of your needs. All right. So we are Libras Connect Consultancy, business consultants, and business and real estate tax strategists. Thank you so much for joining, and I will see you in another recording.